So we can look at this question that is under valuation. Don't forget, when you want to value, when you want to make a valuation of a business, or you want to value bond, sorry, not valuation of a business. If you want to value bond, right, the question could say, oh, calculate the value or theoretical value. When they say you should calculate the theoretical value, what are the things you should look for? What are the elements you need to pick out from the question? One, the interest rate, the nominal value, the numbers of years. If the yield to maturity is given to you in the question, but if it is not given to you, you have to calculate the yield to maturity. Of course, we'll get there after this illustration. Now, example one, a bond with face value of 1,000 naira pays annual coupon of 8%. If the bond has yield to maturity of 10%, you can see the yield to maturity is given, and the maturity date is for 5 years. Compute the current market value of the bond. That is bond valuation, right? It's used to determine the market value of a bond, right? What are the things we need to bring out? Interest, which is the coupon, interest elements, right? After interest element, what do we have again? What are the ingredients to class?
Number of years.
You know, look at it, you can screenshot it. Can you see it? Interest, numbers of years, nominal value, and yield to maturity. Number of years, yield to maturity, nominal value. So we can pick now from the question. Let's quickly go back to the question coming. Okay. Okay. So suggested solution. So what is the interest in this question? So the interest is what? How many percent, class? The interest is what?
8%.
8%. So 8. So how do we do it? 8. So is it ordinary 8% or what? Is it 8% that we write, Abi?
That's why I was saying that I think in the LLM we need to add coupon payments, which is
Oh,
8% of 1,000. That's
okay.
8.
Oh,
Yes, sir.
okay. Oh. Interesting. Mama. Hmm. the 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 interest is like, I'm not saying you should add, you just, what will be the interest element for you to give this person money? Just the interest element. And it is just 8%, right? It is just what? 8%. We just need what the interest amount. Let me call it the interest amount from there. So now, how do we get the interest amount? Is it 0.08 or what?
8%, 8 over 100 times 1,000, which is 80. 80
Hmm.
naira. Yes,
Hmm.
sir.
Mama, I'm supposed to send something to you. I will do that for your data.
Thank you, sir.
Nice one. Nice one. Makes sense. Makes sense. You still remember the way we normally do it in cost of capital. Now, don't forget that in cost of capital, the interest of a bond is 8%. So how do we determine the value? It's just the 8 over 100 times the nominal value. 8 over 100 times the nominal value will give you the amount of the interest. Class. With that, it will give you what? The amount. We've done that. We did this similar something like this in what? In valuation, in cost of what? In cost of capital. Right? So which means that we come back and say times, excuse me, nominal value is 1,000 equals to 80 naira. So the interest is 80 naira, right? The interest is what? The interest is what? 18 naira. Are we good? Are we still together?
Very well, sir.
Okay. So the interest, oh, my system. Hello, confirm. Can you hear me?
Yes, sir.
Okay, okay. I thought
Yes,
this was
sir.
my
I
system.
can.
Okay, okay, okay.
Sir,
That's fine.
please, the question, Unko.
You just dey join us now. That's why you don't want to show us your video. Hmm?
Oh, okay, okay,
When you are
okay.
just joining us, you are just joining us now, right? You can't see my screen. Please confirm. Please, can you see my screen? Please confirm. Okay. Okay, please check your network. So now the maturity is for 5 years. So the lender will receive interest from year 1 to year 5. Numbers of years is 5 years. Now, yield to maturity. Don't forget I said something about yield to maturity. Sometimes the yield to maturity may not be given to you. Most times, we'll get there. That will take us to yield to maturity, right? So it's given in this question as 10%. As what? As 10%. So the nominal value is 1,000. So now we need to determine the value. What is the question? The current market value of the bond. Don't forget, when the question says calculate the valuation. Valuation means market value, class. When the question says calculate valuation, valuation means market value. When the question says that determine the theoretical value means market value, right? Theoretical value means what? Market what? Market what? Market value, right? Please take note of that and just ask yourself, what are the ingredients you will use, right? What are the ingredients you will use, you will actually use to solve that question? And these are the ingredients that you will use, right? So now let's put it in our normal discount table, right? The way we usually do. So we can have here, right? Items, cash flow. Please write it in full. CF can mean like CF. It means so many meaning. It has different meaning, please. Let's say this is 10%. This is PV, right? This is what? PV. So we start from the interest. So, the lender will receive interest from year one. From year one to what? From year one to year 5. Is that not so? From year one
Yes.
to year 5. So we can now have year 1 to year 5 interest. So interest is 80. Then you give me the DCF. Please give me the annuity figure. You can check. Either you
3.7.
check the back of your question paper. At the back of your question paper, there is annuity, right?
3.7.
Or you use your calculator to calculate annuity. Do we have anyone that does not know how to calculate annuity? If you don't know, you better talk. Oh. So what do we have? What is the annuity?
3.79.
3.79. What is the value? What is the value?
303.
303. What do we have next? Where did I get this 10%? 10% is your yield to maturity. Oh, please. What you will use to discount it is yield to maturity, class. You will use the yield to maturity to discount in order for you to get the market value of a bond. In order for you to get the theoretical value. In order for you to get the valuation of the valuation, right? You use what? The DCF is yield to maturity, right? It is given in this question. In some questions, you have to determine yield to maturity before you can determine the market value. Please mute your mic. So the next thing is the nominal, the cash flow, nominal. Oh, don't forget that
Year 5, redemption.
redemption. Thank you. Don't forget that this nominal is just like a face value. It's just like your principal, right? So at the end of that year, don't forget that you've already paid, you will receive interest from year 1 to year 5, right? Year 1 to year 5. At that same last year, as that same year, you will do what? You will recoup back your principal, right? You will recoup back your principal. You can call it redemption or the nominal value of 1,000. Or you can decide to say, oh, you pay interest from year 1 to 4. You can change it. You can put this on year 1 to 4. Then when you come to this last side, you can say nominal plus what? Plus interest. Anyone that you want to do, please do. Right? You can decide to say this is year 1 to year 4 interest. In year 5, you pay interest and the principal. You can decide to say, oh, nominal value plus principal. By then, you've used year 1 to year 4 year, right? Whichever one. So, what is the DCF? This is ordinary DCF. What is the DCF?
0.
What is the DCF?
0.621.
0.621. 0.621. So what is the value?
620.
620. So what is the market value? Add it. It is a cash flow for the lender. Market value
923.2.
923.2. Thank you. So
621. Okay, sorry, you can remove the point 2. I think I got point 2 from my end.
that's fine. So is this market value? Is it at par or at discount? Because in some question, the question may say, oh, calculate the market value, theoretical value, and explain if it is at par or at discount. Class, who can tell me, is this market value, is it at par or at discount?
Discount.
As distance.
A
At
discount.
discount. Okay, at discount. Because the market value
A
is below the nominal what? The nominal value. And that is why this market value is not what? It's at discount. So this is as simple as ABC. All these
Hello,
are cash inflow.
Ibrahim.
Go ahead.
Hello, Ibrahim. Thank you for the lecture. Yes, how do you know it is at discount, please?
Pardon?
I said, how do you
Please come
know
again.
that it is at discount?
Okay. You see okay. You didn't start. I'm not sure you start this class with us. Right. The market value, when the market value of a bond is less than the nominal value, you can see the nominal value is 1,000. So it means that the market value is at discounts. But when the market value is greater than the nominal value, it means that there is a premium, right? You will gain, you have enough, you have more, there is additional money from your investment. And that is why it is premium. When the market value is greater than the nominal value, right? You can say the bond is at what? Is at premium.
All right,
Are you
thank
good?
you. Thank you.
Yeah. So can we continue now? I just needed to show that, right? So this is market value at what? At discount, because question may tell you that, okay, after that, is it at discount or at what? At premium. You can see bond valuation is very simple, right? Very simple. Just understand these things. Once you understand the steps and how to determine all these jargons, we'll move from there. So now, next, What next? Yield to maturity. I hope I can finish this class. Yield to maturity. Class. Yield to maturity. Class. Yield to maturity. Don't forget, when you want to determine the market value of a bond, yield to maturity. Let me on my video. Probably when you see the demonstration, you will still understand more, right? Samson, are you still with us?
Yes, sir.
Rachel, okay. Rita, are you still with us? Okay,
Yes.
okay, thank you. Now, class, I want you to understand something in bond. Yield to maturity, right? When you want to determine the market value of a bond, yield to maturity will be used to discount it. Most times, yield to maturity will not be given in the question, which means that you need to determine yield to maturity. Class, yield to maturity is to bond. That language, that's words, that's jargons is used in bond, right? Why internal rate of return is to what? Internal rate of return is to capital projects. In capital investments, you could say, oh, determine the calculate the what is it called? Internal rate of return, right? But in bond, right? In bond, it is not internal rate of you say, oh, calculate the yield to maturity. Yield to maturity means that what will be the return? What will be the return? It's just like your return on your investment at the date of what? At the date of maturity. So what will be the percentage of this return on investment? Because that is what I will use to discount that particular bond. Maybe the bond may be for 5 years or for 6 years. It depends, right? Now, when you want to determine the yield to maturity, you use internal rate of return. Class. Question. This is how the question on bonds usually come. You cannot determine market value of a bond without yield to maturity, which means that you need to calculate yield to maturity. When you calculate the yield to maturity, you cannot determine the market value of a bond, because what you will use to determine to discount the market value of a bond is yield to maturity. That is why you will not see in the question unless if you were given credit rating, of which we will get there. Unless if you are given what? Credit rating. You can use that to discount it. But without credit rating, a question, you need the yield to maturity to discount it in order for you to get the market value. So when you want to determine the yield to maturity, you use what? You use internal rate of return. The question now is, what are the ingredients you need when you want to cook soup? Sorry. When you want to, when you, Samson, are you still with me?
Yes, sir.
So I like to use such illustrations so that
Makes
when you
sense.
see,
Makes sense, sir.
yeah, so that you can recall, right? So when you want to cook soup, for instance, you need some ingredients, right? So what are the ingredients you need from your question, right? What are the ingredients you need from your question, right? Now, one, number one ingredient, number one ingredient you need when you want to determine the yield to maturity. Although there are some formulas for it, right? There are some formulas to it. What are the ingredients? What are the ingredients? What are the ingredients? What are the ingredients? Okay. The market value, interest rates, interest, which is coupon. Then what is do you need? Market value, interest, you need the nominal, the nominal value. Then the numbers of years is also very important. Class. So therefore, you cannot be given two unknown. You can see when you want to determine yield to maturity. Class, understand this thing. Oh, let me come back again because you will still do some mathematics. Interest plus the nominal value will give you the market value. At the same time, when you want to determine the yield to maturity, which is this, you need market value. So therefore, you cannot be given two unknown, right? Either they give you yield to maturity to calculate the market value of a bond, or the market value is given to you in the question, then you have to determine yield to maturity. Either of the two, because you can't have two unknown. The question can't tell you to determine the market value and yield to market value and yield to maturity. When you want to determine the market value, yield to maturity, element of what you will use to calculate the yield to maturity will be given to you in the question, right? So you can't have two unknown, right? We'll get to credit rating whereby you need to use that to discount. Now, the market value here, you want to use internal rate of return. Don't forget the positive NPV and negative NPV. Now, exclusive, this is where you will have year zero, because you want to use internal rate of return to calculate your E to maturity, right? This now will be at year zero. This is where you will now have your year zero. So the interest depends on the numbers of years, right? Then you have what is it called? The nominal value could be 100 or 1000. So it is when you want to determine yield to maturity, probably the credit rating is not given. We'll get to credit rating actually. Then when you want to determine that, the market value might have been given to you in the question at year zero, will be given to you. So the interest coupon, the nominal value, and the numbers of years. With these elements, your market value is cash outflow, year zero, you bracket it. Interest is an inflow, nominal is an inflow, then the numbers of what? The numbers. So this, you will use it to determine your what? Your yield to maturity using what? The internal rate of return, which means that you need to calculate for the positive NPV as well as what? Negative NPV. Class, are we still together?
Yes, sir.
Okay. What next do we have here? Duration of a bond. Duration. It is only in theory you can determine the duration of a bond. ah, in practice, duration of a bond does not exist. Like when I say it does not exist, you can't calculate it. You can't even calculate it because uh let's say the recent government I think is on treasury bill. I think it's on bond. It's on bond. Yeah, about the numbers of years is actually stated. I think it's for like 5 years thereabouts. So in practice, the 5 years will be given to you. Oh, it's for 5 years. You make your decision. What will be the return? In theory, right? In theory, you need to determine the duration of a bond. You need to determine the duration of a bond in theory. So what is the question now is what is duration of a bond? Class. Duration of a bond is to payback period. You can match duration of a bond to payback period. Class, are we still together? So duration of a bond is a measurement of average life of a bond. Duration of a bond means when you will collect your principal and interest. I want to know the years. Let everybody move. I want to know so that everybody will go on their own. Hope we no meet again. Right? Duration of a bond is to payback period. You want to know the period at which you will use to recoup back your investment. That is why it is called, it is the average life of a bond, right? That is duration of a bond. Don't forget, it does not exist in practice, but in theory, there is what? Duration of a bond. Characteristics, how to determine the duration of a bond. We'll get there. Immediately after the characteristics, we'll look at how to determine duration of a bond. Class, how to determine duration of a bond. We'll look at that immediately after characteristics of a bond. 1. Duration is inversely related to coupon. Please don't forget that I said I don't have notes on valuation of a business. So the only thing I have is what is it called? Questions. I have questions. Right. Just follow like this. Right. Duration is inversely related to what? To coupon rate. Of course, there are two different things. Duration means time. Coupon means what? Interest rate. So they are inversely related. Duration is inversely related. Yes, we can say related to maturity. Related to yield to maturity. That's all. How to calculate duration of a bond in theory. Should I include it? How to calculate duration of a bond? Rita, are we still together? Where is
Yeah.
Oluwapemisire? Okay, that's fine.
Yes, we are together.
Okay, that's fine. So duration is inversely related. Of course, duration is that like when will I recoup my investment? It's like you to maturity. At the date of, I want to know. They are what? No, this should be okay. They are inversely related. Yes, maturity is different. It's different. So, and that is the characteristics of duration of a bond. Now, the question now is how to calculate the duration of a bond. Class, why? See, you don't need much thing in bond valuation. Oh. What you need in bond valuation is how to determine the value of a bond. If they say, oh, theoretical value or calculate the value, how to determine yields to maturity. The next is duration of a bond. These are where ICANN or ACCA question comes, right? How to calculate what? The duration of a bond. Remember, it does not exist in practice. Now, first is you have the numbers of years that you will use to pay the interest elements you will pay, items, cash flow, present value, weigh in, right? Then PV, don't forget I say it does not exist in Fati. So any language I use here, you should know that it's a theory language, right?
So, but this does it exist in Python?
Is Eh, eh, it exists though.
That's just what I want to know, so that we can focus. We can really focus, not just to assume that come out. It might not come out.
That is why I said in practice it does not exist,
Okay.
right? That's why I said in practice it does not exist. Duration of a bond does not exist in practice. Right? We can't calculate it, right? A company that wants to raise 50 million bonds will tell you that it is for 5 years, right? We tell you that it is for 6 years. But how can we ask you? Go and check. How can we ask you question? Calculate duration of a bond. So now, if this is established, right? Of course, during this period of bond, please understand this part. During the period of a bond, the lender will receive interest. Then at the final date of maturity, you will pay the interest and the principal, which is the redemption. Is that not so? So now, during that bond period, the borrower will pay the lender interest and principal. That is what you will use, interest and principal. Year one, you pay interest. The cash flow will be there, right? Why in yet now the question now is, where is the DCF? I didn't put DCF. DCF. Now, what will you use to discount it, class? What you will use to discount your duration of a bond is yield to maturity. You can see how yield to maturity is very important. Class, let me put it here. Open brackets. Yield to maturity. To discount. You can see how yield to maturity is very important. It's very what? Important. Now, after that, because question cannot tell you to determine duration of a bond without giving you the element for yield to maturity that you use to discount it. Now, why do we have to use interest? You will pay interest to the lender. At the end of the year, you will pay principal during during that duration of that bond. Right? So therefore, the cash flow, right? Then the interest, the DCF, sorry, the PV. Now, what is weighing? According to the theory, right? Weighing means the numbers of years. The first year. When we get to the second year, you will use 2. When we get to third year, you will use 3. Assuming like that. It is an assumption, right? Interesting. Now, right? Weighing means that year. You know, you are in year 1 now. Is that not so? You are in year 1. So you just write year 1. That is the theory, right? That is the what? That is the theory. So now, you come to this side and where is it? Okay. 1. Then PV, your present value times your weighing will give you this part. So year 2, you pay interest. Now the interest may not be the same. That is why we have to do it separate. Now for me to do it this way, it means that, like I said, I have if it is question, over 1,000 questions, SFM, FM, AFM, right? So I've seen different case scenario. The interest element will not be the same, and that is what we call floating bond. That is what we call floating bond. When you have different interest rates, that is what we call floating bond, right? Now, the DCF is the cash flow, right? So the DCF for year 2, when you multiply, you have your PV. Your weighing will be year 2. It's based on the numbers of years. Will be year 2. When you multiply your PV times your weighting, you have this, right? Next, I will assume it is for 4 years. In the 3rd year, you pay interest of this. The cash flow, maybe 15 naira. The yield to maturity, when you do your DCF, what do you have? Maybe you have this. Then when you multiply, you have this. Then 3rd year, you put 3, then you have this. Don't forget that it is assumed to be 4 years, right? So at the last year, you will still pay interest, right? You will still do what? You will still pay interest and what? And principal and redemption. You can call it interest and redemption, right? Interest and redemption. Don't forget that the redemption or the nominal value or the par value may be 100 or 1,000. So year 4, interest plus par value face value or nominal value, which other name? Redemption. I'm giving you different name that you can see in question, right? Now, let's say you have this, right? When you add together the DCF, the PV, the weighing will be 4. So when you multiply, you have this, class. So duration of a bond. Let me reduce this part so that if you don't understand, or mute your mic. This is just how you will calculate duration of a bond. I'm just showing you how you will calculate it. Ideally, I'm supposed to just give you, but I want you to understand how it works, right? During that period of bond, you will pay interest. At the end of the year, you will pay interest and principal. That is the redemption. So when you add this PV times weighing together, you have your total here, right? You have your what? You have your total. You have your total coming. So please, you will add your PV as well. Add your PV together. What do you have here? Let me put it this way. PV, right? You add it together, you have this. Now, duration of a bond. Duration of a bond now. Although there are other formulas for it, but I don't want to use that formula for duration of a bond, right? So for you to calculate duration of a bond now, duration is equals to PV times the total of your PV times your weighing divided by the present value. We give you the duration of a bond. We give you the duration of a bond. Class, unmute your mic. Are we still together?
Yes, sir.
I guess we are tired, right?
We are together.
Okay, good. So there is another one called modified. This one is not common in ICANN exam, but let me prepare you for the worst case scenario. Modified duration, just like modified internal rate of return. Modified duration is duration. When you get the duration, I'm just preparing you for the worst case scenario, right? 1 plus R. Your R here is your yield to maturity discount. The yield to maturity that you use here is your R. Then you get your modified internal rate of return. Class, this is how to determine duration of a bond. You can see how yield to maturity is very important. If we don't know how to determine the yield to maturity, we may not be able to value bond. We may not be able to calculate the duration of a bond because that will be used to discount the project. Right? Distinguished professional colleagues, I think I'm tired. I think I'm tired.